Hey everyone, welcome back to the Economic Analyst channel. In this video, I'm going to lay out the foundation for my reasoning of why I think that we are going through another depression similar to the one that we had post-2008 coming out of the Great Recession. It's not like the ones of 2008 or even the famous Great Depression that we had during the 1930s, where that was characterized by very stagnant prices, high unemployment, and sluggish economic growth. Instead, it's going to be the opposite. It's high prices, high price inflation that's eating into economic growth, and this is being fueled by a credit and spending binge that has been caused by government, fiscal, and monetary policies. Essentially speaking, the government, in its drive to avoid a stagflating Great Depression of sluggish prices and sluggish growth, have created a hyper bubble in our economy of rising inflation fueled by credit. That's now, on the plus side, it has put people back to work faster than what otherwise would have happened during a normal market correction process of a recession. But it's come at the price of very high prices in the economy, as well as government subsidies to unemployed people that have basically put a drain on real resource growth. So, if you've paid attention to my videos on gross output, this is the fourth quarter of gross output numbers. So this video is an update on those numbers. And as I've mentioned before, I like using the gross output numbers versus GDP because the gross output gives you an idea of how the entire economy is functioning. Whereas GDP concentrates on the consumption part of the economy, gross output control, gives you a scope over not just the GDP or consumption, but also the production side or the investment side of the economy. And it's those two sides together that makes our total aggregate economy of employed people working to produce goods for all of society. Now, when we adjust for producer prices on the producer side and adjust for consumer prices on the consumer side, we can see here that in green, which is the measure of real GDP as I calculate it using the consumer price index, while real GDP is showing a positive growth rate right now, it's actually showing a very high growth rate of 4.7%. Normally, that might make you think, well, the economy is doing well. But when we take a look at the gross output, the real gross output, which is in blue, we can see that gross output growth has really dropped and stagnated, and it is now threatening to actually go negative or enter a gross output recession, a total recession on the economy. Now, normally, economic analysts will not call this a recession. The Bureau of Economic Analysis defines it as 2 consecutive quarters of negative real GDP growth because today's economists are too obsessed with the consumption side of the economy. But when we take a look at beneath the surface there, we see that the iceberg is a lot larger than what's showing up above the surface. And beneath that surface, we're seeing in red here, this producer side of the economy is negative. And I've made a couple of videos about this gross output and expressing my concerns in the previous quarters. My big one was that I was worried that this negative production growth would start dragging real GDP down, and it will do that, and possibly cause a recession, much like what we saw in 2008, except that was caused by the bursting of a credit bubble. This is caused by high prices, especially on the producer side. And it's been this divergence between the higher producer price inflation rates and the consumer price inflation rates that's causing this divergence between the production side and the consumption side of the economy. But as I've maintained, and I will maintain this to the day I die, you have to produce goods in order to consume goods. You have to grow food out of the ground in order to eat food. You have to drill oil in order to use oil. If you run out of oil or if you run out of food, then you're going to run out of things to eat and you're going to run out of energy to use. So this real GDP number is a lagging indicator of economic growth. In truth, you need both sides put together to get the essence of what real economic growth is, and right now it's very sluggish. When we take a look at the index numbers right here, it becomes more apparent that we're in a depression, because a depression is usually defined as a drop or slump in economic growth and not recovering back up to the previous peak. And that's what we're seeing right now. Even though our economy is technically expanding on a growth level, especially by GDP numbers, on the gross output metric, it is growing, but it's growing barely, and it's not recovering back up to its pre-pandemic point. Because it's not coming back up to its pre-recession, pre-pandemic point, it's more of like a bowl. It's not really showing any kind of true net growth. And as we get more people entering the population that needs to be sustained with food, water, clothing, shelter, and energy, it's becoming a drain on our economy. And this might explain why we're seeing a divergence between economic statistics that seems to illustrate that our economy is booming very strongly, and sentiment among the public that the economy is not really doing well at all. While Wall Street is obsessed with statistics and bottom line earnings of corporations, which are, showing growth in the economy, Main Street is really hitting the lag as high prices on the consumer end and high prices on the producer end, causing lagging growth on that producer side, is really still putting a drain on our economy. When we take a look at what happened post-2008, we can see how gross output dropped even much lower than real GDP did, especially on the producer side. And it took years before the aggregate real gross output numbers recovered back to their pre-recession point. As a matter of fact, it took over 5 years to reach that point once again. And that might explain why it took so long for employees to reach back up to the numbers of people in the actually working and employed. It took it over 6 years for our economy to recover back to that point post-2008. We're seeing a similar situation now. Yeah, it's true, real GDP right now is higher than what it was pre-pandemic, but when we take a look at total employees in the workforce, we're still about 1.6 million people less than what we had working and employed as of February 2020, right before the pandemic hit and the government shutdowns. The reasons for this is in large part due to the high amounts of government spending, particularly the government spending that is devoted to consumption. In other words, the government is paying more people to consume goods without working to produce goods, and this is putting a net drain on our economy. When we take a look at government spending, and I'm subtracting in the blue line government spending minus the gross government investment, which is what government spending is devoted to actual production in our economy, we can see here on the blue that government spending on an annualized basis is substantially higher than we've had in the past 50 years. It's been on an upward trend as government has gotten larger over time, minus what we saw in the 1990s due to the dot-com boom. But now what we're seeing is that these high levels of government spending has crowded out private sector investment and growth and is destroying real resource production. Until we start seeing these government levels of spending start dropping down to, say, what we were seeing around 2015 after we fully recovered from the recession of 2008 and 2009, we're probably not going to get calming down in the inflation rates and a speed up or pickup in economic growth, particularly on this consumption side. While Keynesians will argue that this gross government investment component can actually grow the economy, aka we need to invest in infrastructure, even using that metric, I would argue that those goods investments are subpar to what we produce in the private sector. No government employee goes out and helps you grow food out of the ground. No government employee becomes a farmer. No government employee is helping us produce more oil out of the ground or drill. No government employee is inventing things that we can use to help increase our standards of living. No government employee is working on an assembly line putting together parts for a machine such as a car or helping assemble computers together. No government employee is selling goods or actually actively trying to increase retail sales in the market or act at least as an intermediary between buyers and sellers. those are net drains on the economy because all of those government employees are using land, labor, resources, and other production materials to do whatever they're doing, which is basically worthless bureaucracy. When we take a look at where in the gross output that the economy is suffering, it becomes apparent that it's on the production side, as manufacturing and construction has not reached back to their pre-pandemic levels. The only thing that has increased has been retail trade, which makes sense because that's primarily devoted to consumption, which would be measured in higher GDP numbers. Taking a look at the GDP numbers themselves produced by the Atlanta Fed, we're looking at another quarter of relatively sluggish economic growth as the Atlanta Fed is coming out with a 1.5% annualized growth for GDP, real GDP, for the first quarter of 2022. So when we start projecting out the gross output metrics, the outlook is pretty dismal. If we're not going to be thrown into a recession using gross output as the metric, we will very shortly in 2022, as higher producer prices and consumer prices will drag down growth into the negative on that gross output level. You can really clearly see it on the index that I have here based off the projections, and the projections that I'm using is based off of my CPI numbers. I basically annualized and taken the average and median growth rate of the CPI and the PPI, have projected out those prices and overlaid it against a forecast of what I think gross output will grow at on a nominal basis. And unless if we start seeing a pickup in that growth in the gross output nominal basis, or a drop in the price indices, or a drop in the growth rate of the price indices at least, we're probably going to have negative growth on that real gross output level. Now, do I think that this is going to prompt a technical recession as we tend to look at it on a real GDP basis? No. What I do think, though, is that the real GDP numbers will start to drop and stagnate, and that will cause concerns and ripples among the investment community and Wall Street, as well as the economic statisticians and government bureaucrats, to say, hey, look, something's going wrong with our economy. What I'm giving you is something to look upstream, and I'm saying that what's going on upstream is that the river is drying out. Downstream, it hasn't been hit or fully realized yet, but it will very soon in the coming quarters based off of this analysis that I am providing here. Guys, that's all that I've got for today. Let me know what you think about all this. Let me know your comments. Just drop that down below. Show me some support if you want to. Just click that like button. Subscribe to my channel if you haven't already. That way you're always notified when I do produce and upload videos. Again, I'm keeping a close eye on this. The next video I'm going to produce is on the yield curve. I know that we've gotten some update situations on the yield curve. I'll definitely produce an update video on that later on this week. And then, of course, stay tuned out for my inflation forecast numbers that are going to come out probably late this week about to reiterate what's going on with the next month's inflation that are going to come out the week after next. Once again, guys, I thank you for watching this video, and I'll talk to you next time.